This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. We're now going to look at the debits credits to end up with what we require in the statement of financial position and income statement. And we're going to have to in fact look at two examples, the first and second year of the same business, to show you everything that could possibly happen. And I must point out, particularly when we come to the second example, that there are in fact various ways of ending up with the same result, and as long as we end up with the correct result, it doesn't matter how we do the debits credits, the way I'm going to show you is by far the easiest and the safest. So if you want to do it differently, fine, but this really is the safest way. Anyway, let's do it. If you turn please to page 55, example 2. Scylla started business on the 1st of January 2000, and as at the 31st December 2000, the balance on her receivables account was 82,000. On investigation, it was found to include the following debts. Now, we'll look through them one by one shortly, but there are 4 debts there where there's some sort of problem. And in addition, we've decided to have a general provision of 4% of remaining debts. So, we're going to do the T accounts and sort out how we end up with the correct figures in the financial statements. So first of all, let's open up an account for receivables. And at the end of the year, it says the balance was 82,000. So the bookkeeper during the year has been recording sales on credit, cash received. We arrive at the end of the year, and with a balance, it'll be a debit balance, an asset of 82,000. And of course, if there was nothing else, that would appear on the balance sheet as a current asset. However, we've investigated, and there's various problems. Well, the first thing always is to work through, deal with any irrecoverable debts. For the moment, ignore anything else. But remember, any irrecoverable debts we're going to remove completely. So, let's work down. A. John owed 5,000. It's irrecoverable. Well, let's remove it. To remove it, it's included in that debit balance of 82. So surely to remove it, we need to credit with 5,000. If we credit with 5,000, that receivable is completely removed. The double entry, well, the cost of doing that, we'll debit to an expense account, bad and doubtful debts expense account. I said before, bad debt's a word you'll often see for irrecoverable debts. Strictly, it should be irrecoverable and doubtful debts account. It just takes a long time to write. But anyway, here's our expense account where we'll record the cost of everything we do. So to remove John, credit receivables, debit the cost of doing it to the expense account. Receivables, I can't write irrecoverable and doubtful debts. I'll just say irrecoverable debt expense. And we do the same for all the irrecoverables. So for the moment, ignore everything else. Ignore George. George is doubtful. Come back to him later. However, the next one, Paul. Paul is irrecoverable in the same way. Credit receivables, this time 3,000. Debit irrecoverable and doubtful debts expense account with the cost 3,000 of what we've done. Any more? No. Anne is doubtful. Worry about her in a moment. There's a general provision. So always do that first. Deal with any irrecoverable ones, remove them. And at that stage, the balance on receivables, after removing a total of 8,000, we end up with a balance of 74,000. And that, remember, that is the amount that we're hoping to collect. However, although we're not going to change that 74 in the T account, on the balance sheet, we're going to deduct from that our allowance for any doubtful ones. So, before we complete the double entry, always do a bit of arithmetic, do a little statement of the allowance that we need. And remember from example 1, there are two types of allowance. First of all, what we call a specific allowance. In that 74,000, are there any specific individual receivables which are doubtful? And go back to the list that are. First of all, there's George. George owes us 8,000. He's included in the 74, but he's doubtful. In addition, Anne. Anne owes us 2. She's doubtful. So in total, 10,000 of our receivables are doubtful, and on the balance sheet we are going to reduce by that 10,000 to be safe. That's a specific. In addition, though, we're going to have a general provision. Now, I explained why and what that meant in example 1. Let's do it. The general provision or allowance means the same thing. It's 4% of remaining debts, and it's always calculated this way. We take whatever the percent is, here 4%, of whatever debts we think are good. And how can we check? Well, if you look back at receivables, after removing the bad ones, we're hoping to get 74. However, of that 74, we've just said that 10,000 of them we know are doubtful. And so the only ones we feel we're absolutely certain of are the remaining 64,000. And we take a percent of that figure. It's always of whatever we think we're certain. The receivables after removing the bad ones, and less any specifically doubtful. So 64,000, 4% is 2,560, giving a total of 12,560. Now that was just workings. But in total, on the balance sheet, we want 12,560 deducted from our receivables. How can we reduce our receivables by 12,560? What we could do, of course, but don't do this. If I credited receivables with 12,560, it would reduce the balance. However, remember, although we're going to reduce it on the balance sheet, we do need to show separately the receivables we're trying to collect and the amount of the allowance that we're deducting. And so we open up a new account. Instead of crediting receivables, we open up a new account called Allowance for Receivables. And we'll use this account to record the amount we're deducting on the balance sheet. We want to deduct 12,560. Well, because receivables are a debit, we'll credit this account with 12,560. And when we come to do the balance sheet, we'll take the balance on receivables, a debit. We'll deduct from it the balance on the allowance, a credit, to get the final balance sheet figure. What about the double entry? Well, of course, although this figure we are using it to reduce receivables on the balance sheet, the cost of doing that we'll debit to our irrecoverable and doubtful debts expense account. Credit allowance, debit, irrecoverable and doubtful debts expense account. And now we've finished. Receivables, the balance is 74,000. It'll appear on the balance sheet, and so we'll leave the balance there. Irrecoverable and doubtful debts expense account, well, here's the total cost of everything we've done. So in total, what is it? 20,560. Again, it's the total expense, the total cost. We'll move it to the income statement. Credit the expense account, debit income statement, as we always do for expenses, 2560. There's no balance left on the account. Finally, the allowance for receivables, there's a balance of 12,560. This is going to appear in the balance sheet as a deduction from receivables. We'll leave the balance there. Finally, although I hope already obvious, Part B says show extracts from the statement of financial position and the income statement. Well, in the statement of financial position, the balance sheet, under the heading current assets, we'll show receivables. The balance on the account was how much? 74,000. But to be safe, we'll deduct our allowance for receivables. How much was it? Well, from the T account, it was 12,560. And so the final figure on the balance sheet is 61,440. On the income statement, under the heading expenses, we'll have all our normal ones: telephone, electricity, depreciation, but we'll have irrecoverable and doubtful debts expense. How much was it? The cost of everything we've done, it was 20,560. And there we are. Okay, now hopefully that's not too bad. Remove the irrecoverable ones, calculate the allowance or provision that we want, and then put through the entry. However, to be safe, we do need to carry on and look at what happens with Scylla next year, because strange things can happen. For instance, in this example, John was irrecoverable. We were certain we were never going to get the money, but of course you can never be certain. What happens next year if John pays? Well, I'm going to have to show you. Also, the doubtful ones. George was doubtful. Well, he was doubtful at the end of this year, but surely one of two things is going to happen. Either next year he'll pay us, in which case he's not doubtful, and how are we going to deal with it? Or if he still hasn't paid at the end of next year, then of course we can't keep him doubtful forever. If he still hasn't paid in another year, then we're going to almost certainly decide he's bad or irrecoverable. And so, to cover everything that can happen, we'll have a break now, but then the next session we'll take Scylla, we'll take the question we've just done, and we'll look at what happens next year.